Robert Kiyosaki is a wealthy entrepreneur, perhaps best known for his book Rich Dad, Poor Dad. He's also run multiple businesses and made many types of investments, mostly with a high degree of success. His most recent business has provided success to not only himself, but many others as well. Kiyosaki now runs a financial education company that provides finance and business education to students through books and videos. Now worth about $80 million, Robert Kiyosaki wasn't always rich and successful. In fact, it took him several failures to get to his current level of success, which didn't come until later in his life. He's dedicated his entire career to learning about money, investing, and running businesses. What are his best points for reaching financial success and avoiding the rat race, and how can you use them to reach your goals? Take special note at number 6, which has been a life-changing concept for so many rich people. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Number 1. Learn financial literacy through experience. To be financially smart, Kiyosaki says that you must learn accounting, investing, laws, and how the markets work. It's important to know how money works so you can use it to your advantage. Financial knowledge has many faces, and there can be a lot to learn, but unfortunately, these are not emphasized in school. Life skills such as management and communication are equally important and aren't taught in school either, because schools train kids and young adults to become successful employees, not business owners and investors. Kiyosaki famously stated how he purchased his first investment property, a condo in Hawaii, for $18,000. Although it wasn't enough to make him rich, the experience he gained was invaluable, giving him the knowledge to do larger deals in the future. Taking educated risks is key in the business and investing world. Number 2. Avoid fear and self-doubt. Anyone who's created their own success will tell you that failure is inevitable and an integral part of succeeding. Robert Kiyosaki has failed in different business and investing ventures, but he doesn't let those setbacks limit his potential. If you have an amazing idea for a new business, fear and self-doubt could keep you down, preventing you from moving forward with that million-dollar idea. The ones who get rich in the real world aren't necessarily the smart people, but the bold people. They're not afraid to take a chance, and they know the possibility of failure is always present. However, they know the reward is worth the chance. Rich people take risks because they find opportunities in life that can potentially turn them into billionaires. Number 3. Learn to sell. Once, a woman with a master's degree in English literature asked Kiyosaki how she could become a best-selling author. Knowing that the writing skills are not the most important factor, he advised her to enroll in a sales training course. The woman was taken aback by his answer, and she asked him if he was serious. Kiyosaki picked up a book from the coffee table and replied, "There's a reason successful books say best-selling author, not best-writing author. Selling is a crucial skill if you want to be rich," he explained. Kiyosaki himself turned down a high-paying job in the oil business to work for Xerox to learn how to sell. Get out of your comfort zone, practice selling and networking. If you don't, you'll never be able to run your own business. Number 4. Ask, how can I afford it? One of the characteristics that made Robert Kiyosaki so successful is that he never simply said he couldn't afford something. Instead, he'd ask himself, how can I afford it? What can I do to be able to achieve that goal? Simply saying, I can't afford it, shuts down further creative thought and eliminates any upward potential. Asking, how can I afford it, opens up options for excitement, possibilities, and goals. The poor middle class are fiscally conservative, which means that they can't afford to take risks. The reason for this is that they don't have a solid financial foundation. Simply believing that something is outside of your reach often leads to continuing working for someone else, doing the same thing year after year. The poor middle class think they could achieve a raise in pay or promotion within their company, but that type of thinking is most definitely not the mentality of a rich and successful person. Number 5. Understand how taxes work. Those who work for someone are the ones that pay the largest amount of their income in taxes. When you earn a paycheck, your taxes are taken out before you receive the money, so when you go to spend it, you're spending after-tax dollars. Business owners earn money, deduct expenses, and pay taxes on their net income, spending before-tax dollars. For example, a business owner earns $100,000 per year, but they don't pay tax on that entire amount. Any item that can be legally purchased by the corporation can be deducted from that income. With the help of a legal team, it would be reasonable to reduce that taxable income to $50,000 by using business expenses. That ultimately leaves a taxable income of $50,000 instead of paying taxes on the entire $100,000 in gross income. An employee who earns $100,000 per year pays taxes on that entire sum, possibly leaving them with $80,000 in after-tax income. Then they must pay for their expenses with the money that's left over. Money withdrawn from a 401k is taxed at ordinary income rates, which in many cases is a higher rate than the long-term capital gains rate of 0 to 20% that would be paid using a traditional brokerage account. Since taxes were deferred by investing into a 401k, once they withdraw money during retirement, he or she will be forced to pay taxes on all the money they withdraw at the higher income tax rate, eliminating any tax savings. 401ks also don't offer the flexibility of using leverage. It's much harder to invest using leverage inside of a retirement account, and this limits the type of investments one can make. When investing in rental property, the government allows you to depreciate the building, deduct expenses, and mortgage interest. When the property is eventually sold, the gains are most often taxed at the low 0 to 20% tax rate, usually lower than the tax rate most pay with their 401k. The government has many rules on how much you can put in it, when you can take the money out, and what types of investments you can make inside of it. Kiyosaki recommends against putting money into a 401k, since it only offers temporary tax savings and has many negative consequences, such as those mentioned. Those who are seeking to build wealth and permanently lower their taxes should instead invest in things like businesses, real estate, commodities, and so on. Number 6. Buy assets, not liabilities. This is Kiyosaki's most important concept. He created a lot of controversy when he stated that your house isn't considered an asset, but rather a liability. He points out that because each month the house costs you money to own in the form of taxes, insurance, maintenance, and a mortgage. Regardless of whether or not you agree, it's suggested to buy things that put money in your pocket on a regular basis instead of something that costs money and loses value, such as a car or an expensive phone. One of his favorite examples of an asset is a rental property that generates cash flow on a monthly basis. The middle class gets stuck in the never-ending rat race because they use their paycheck from their jobs to buy liabilities, commonly borrowing money from the bank to finance those items. It's okay to buy liabilities, but only after you've purchased assets that will pay for them. In other words, if your goal is to buy a new car, look into an investment that will pay for that car instead of relying on working income. Don't get stuck in the rat race, earning mediocre wages until reaching your 60s to retire, or worse, not being able to retire due to complete lack of financial literacy. If you don't have the funds to purchase something you want, find out how you can rather than simply believing it's not possible. Use the tax code to your advantage so you don't need to pay more tax than required. Learn as much as you can through experience and take educated risks that have huge potential, instead of getting scared away by the possibility of failure.